Welcome back to TMT. When we spoke about charts in a previous video, we said that yearly, monthly, and quarterly charts are used to analyze long-term trends. Now, we want to make sure you understand what a trend is. Really, when we speak about trend, we are simply referring to the general direction of a market. When you look at any chart, you will be able to see if the successive peaks are higher or lower than the previous ones. If they are higher than the previous ones, we have an uptrend. If they are lower, we have a downtrend. Hence, an uptrend is defined as a series of higher highs and higher lows, while a downtrend is defined as a series of lower lows and lower highs. If the chart is an hourly chart, we may be able to identify a short-term trend. However, if we are using a daily chart, then we may be talking about an intermediate-term trend. And as we said earlier, yearly, monthly, or quarterly charts are used to analyze long-term trends. To identify the trend can be extremely helpful for a trader. In fact, we could say that the goal is to be able to identify a strong trend and then go with it until it reverses, kind of like catching a wave. In future videos, we're going to learn how to use trend lines to help us identify trends. Now, just as there is uptrend and downtrend, we also have what is commonly known as a sideways trend. This basically describes when the price movement between supply and demand is very close. Then the market moves horizontally. These periods are considered periods of consolidation before the price continues in the direction of the main trend. This is very important. There is a saying in trading that goes, consolidation typically means continuation, so beware of that. It will help you in the future. Sideways trends are the most risky periods to trade, so traders tend to avoid them and wait to have the wind at their backs by going with the trend. Sideways trend is generally the result of the price bouncing against strong levels of support and resistance. Whoops! What is support and resistance? These are probably the most important concepts you must learn in trading. Support is a price area below the current market where you will look for the possible termination of a decline. It indicates the starting price from which most traders believe price will move higher. Resistance is a price area above the current market where you would look for the possible termination of a rally and consider being a seller. It indicates the starting price from which most traders believe price will move lower. To use words that are commonly used in trading, support is the area where bulls take control of the market, and resistance is the area where bears take control of the market. Have you heard about bulls and bears? Bulls are the buyers and bears are the sellers. The battle between bulls and bears is what makes the market move. Bulls attack with their horns moving upwards, while bears attack with their paws downwards. That is why buyers are considered bulls and sellers are considered bears. In the next video, we will show you practical ways to identify points of support and resistance. For now, you've got homework. For your homework, open up different charts and look for those higher highs and higher lows, those lower lows and lower highs. Identify uptrends and downtrends. If you are in doubt, send screenshots of them to us for correction. Next time on TMT, the psychology of market movement. See you then.